Good morning, friends.
Good morning, sir.
We'll start. Yeah.
Good morning, sir.
Good morning. Good morning. So last class we had completed sensitivity. Now we'll start with volatility. So risk measurement second method is volatility. So what is this volatility? It is sensitivity. We know how much sensitive the security or investment portfolio is when the rate of interest changes. That is called sensitivity. So how sensitivity? Volatility means how stable or unstable it is. So difference between sensitivity and volatility is that volatility talks about the stability and instability of any particular investment. Okay, so it talks about stability or instability of a random variable. Random variable in the sense, what are the random variable? Random variable means whatever we are, our income or market value, whatever it means. So random variables are earning. Basically, when we are talking about risk means earning is the main concept. So whether we are making a profit or loss. So if how much that earning is volatile, how much mark-to-market values are volatile, how much the market value of the security is volatile, and how much loss due to default by the counterparty brings us the volatility in the income. So this is the way volatility is measured. Okay, so measurement of the risk is done by two methods: sensitivity method and volatility method. In sensitivity method, we have seen how to how to calculate the change of price, percentage change of price of a bond through MAC duration and modified duration. Now we'll see in volatility how this volatility works and what is that basis point value and what is value at risk or VAR. These are the two popular methods used in volatility. Okay, so how this volatility is measured? Volatility is captured or measured as the standard deviation. Again, standard deviation comes into picture. So we have to calculate the standard deviation of a particular sample values, where the standard deviation is the square root of the variance of the random variable. Okay. So if we are talking about market value of a security, earning of a security, or whatever it may be. So one random variable you take for different time period or different days, then you calculate the standard deviation of that, and that standard deviation is represented by this symbol sigma. So standard deviation is the square root of variance. So this standard deviation will tell us how much volatile the security is or the investment is. Volatility in the means, suppose today the price of a security was say 60 rupees. So in next 5 days, the price has moved maximum up to 68. And last 5 days, the price was 52. So this is the price range between these 10 days. 10 days price was moved from 52 to 60, where 60 was the price on a particular day. That means, or we can say 52 and 60. Okay. So we can say that if this 60 is the average price between this lowest price and highest price, then how much volatile the stock price was from the average towards the lower end or towards the higher end. So in actual difference is both side 8 and 8. So that 8 is the standard deviation. So if you say the volatility of this stock was 8 for a period of say 10 days, within a period of 10 days, then anyone can understand that if the mean price or average price given 60, that means lowest price was 52 and highest price was 68. So this range is called the volatility. This much was the volatility of this stock. So how this standard deviation is to be calculated? If we know the earnings or market value of the security for a certain period, then how this standard deviation is to be calculated, we will do in the next slide. So please be focus on that. Now, I have taken this share price of a particular share for 5 months. Say March, April, May, June, July, 5 months share price I have taken. So March it was 100 rupees, April it is 110 rupees, May 90, June 120, July 150. Suppose. Okay. Now these are the 5 months price. Now we have to calculate the volatility or the standard deviation, how standard deviation will calculate it, so that we can understand that how much volatility this was for within this 5 months period. So first I have to add all these 5 share prices. So total price what would be there? So if you add this total and divide that total by 5, I get the mean price. Mean price is 114. So 110, 100, 100, 110, 90, 120, 150, whatever the total comes. So it will come as 570, I think. So if I divide it at 5, then the average or mean price I'm getting 114. Okay, the first column is mean. So carefully, you please remember this, because in another numerical also same thing will come, how to calculate standard deviations. Please at that time don't ask me how we have arrived. So please understand this. So first thing is to calculate the average or mean of all the prices. So 5 months mean I have calculated 114. Next column is the deviation. Deviation means here I have written P minus M. So from the share price of each month, how much is the difference between the mean and share price? So share price minus mean. So it becomes minus 14. Next one is minus 0.4. So 90 minus 114 minus 24. Then plus 6 and plus 36. Okay. Now we have to square the deviation. These are the deviation. Now we have to square the deviation. Suppose deviation is the D, then we have to square the deviation. Squaring the deviation, minus 14 square is 196. So 196. Minus 4 square is 16. Minus 24 square is 576. 6 square is 36. 36 square is 1296. Okay. So next step is add all this square of deviation. This 5 to be added. This is 2120. Now after this square of deviation, when we got the sum of square of deviation, you have to find the average then. Average of 2120. So what is the average of 2120? That is very important here, because here in this average, when we calculate the average of the square of deviation sum, we are not going to divide 2120 by 5. We are not going to divide by 5, because Here we have to divide this by n minus 1, where n is the number of sample we have taken. So number of sample is 5. So instead of 5, we have to divide it by 4. So here 2120 divided 4 has to be taken. Why it is taken? Because in case of data sample, of very small data sample, while taking average, if n minus 1 is taken, then it will give the correct result. But for big samples, like population and other things where lakhs of sample or data is taken, in that case, n works out. But in case of small samples, like 5 months sample we have taken, so here, if you take n as the average, then it might not give the correct answer. So always remember, for standard deviation calculation, for simple data sample, we have to take the average by n minus 1 in this spot only, not for this one. Share price, when you have taken average, we have divided it by 5. But here, instead of 5, we are dividing by minus 1. So n minus 1 becomes 4. So 2120 divided by 4 becomes 530. So 530 square root is 2302. So our standard deviation is 23. I can say standard deviation 23. So what does this standard deviation means here? It means the average price or mean price of our share was 114. This is the average price. So it indicates that the share price has a volatility of 23 on both sides of mean price. So volatility means this side and this side. Both sides, the share has moved approximately about 23 for the 5 months period. In this 5 months period, the share has moved downward by 23 and upward by 23. It may not give you the accurate, because here the lowest price was 90. This was the lowest price and this was the highest price. So it may not give you the correct answer, but approximately we can reach. So 114 plus 23 is, say it was say 137. 114 minus 23 means it is 91. So approximately 23 or 24 we can take as the answer. So I can say that the movement of the or volatility of this share from mean was 23. So easily you can understand that volatility means the price has come down by 23 and price has gone up by 23 during this period of March to July. Okay, is it clear?
Yes.
Now see, this is we have taken for 5 months period. Here March to July I have taken. So I have taken monthly data. Monthly data has been taken. So I can say this 23 is the monthly volatility of this particular share. So I have calculated monthly volatility. When I am taking the monthly data, I am calculating monthly. So if for a 1 month period, suppose for a period of, in March, month of March, there are 31 days. So I could have taken 31 days share price and I could have found the standard deviation also. So in that case, that standard deviation would have been the daily volatility. So within a period of 1 month, in period of 1 month, what is the daily volatility? Means 31 days period, daily volatility means per 1 day, how much the price has gone down or gone up. So that is daily volatility. Similarly, we can calculate weekly volatility, monthly volatility, or any time volatility, 45 days or 80 days. So now sometimes questions are asked that how to convert a daily volatility. If you know the daily volatility, how you can convert it to weekly volatility or monthly volatility or any number or annual volatility or any number of days volatility, how it will be converted. In such volatility calculation, if we know the daily volatility amount, then we have to use, so this is daily volatility, suppose this is D. And question is asking to convert it to weekly or monthly or annually, whatever it may be. Suppose this is T. We want the value of T. So this is daily volatility number we know. And this is the T. In such cases, we have to calculate the volatility for the time period T equal to daily volatility multiplied by square root of T. So remember this formula. If we know any of these one, either daily volatility or the time period, then we can get the answer whatever the question is asking. Okay? Is it okay? So suppose question is given, a daily volatility of a stock is say 1.5. So daily volatility is say 1.5. So this is the T. So find out what is the monthly volatility. Can somebody do it? What is the monthly volatility?
8.21.
8.21. Very good. So monthly volatility 1.5 multiplied by square root of 30. So it becomes 8.21 or 8.22. So like these questions will be asked. So first question might be asked, find the volatility of this stock price for a period of say 7 days or 6 months. So like this, you have to calculate the mean or average, then the deviation, then square the deviation, add this one, find the average by dividing it by n minus 1, then square root of that is called variance. Square root of variance is our standard deviation or sigma. So that will be the volatility. Now, if sometimes questions are asked like this, if daily volatility is 1.50, find the monthly volatility. Or if daily volatility is 1.50, find the volatility for 60 days. So in that case, it will be 1.5 square root of 60. So if you know the formula, you can work it out. Okay? Can I move to next one? Now,
Yes, sir.
okay.
Yes, sir.
So volatility, we know how to calculate sigma or the standard deviation. Now, second, next.
It can give 3 months, per month we will count 30 days, sir, or 31 days.
No, 3 months, why? They will ask whether they are asking monthly or daily. Daily means one month data or 15 days data they can give.
Okay,
If you want to calculate,
only we will consider only 30 days.
No, are you calculating the volatility, the standard deviation, or you are calculating this only converting the volatility?
Daily volatility.
No, you are talking about if the daily volatility is given as 1.5, they are telling about monthly volatility, right? Huh? So
Yes.
then 1 month you have to take 30 days.
Okay.
Okay. Why 1 week? 1 week they want, you have to take 7 days. Normally, actually, they will give you. So normally monthly they will not ask, because see, as we understand that in case of such volatility calculation, we are calculating the thing in the investment portfolio, which is a market value, which is a market risk. And in the market, our treasury works, and worldwide, the market works 5 days in a week. So that's why for volatility or VAR calculation, always in a year, 250 days is taken into account. It is taken as 250 days. So in a year, in VAR calculation, I will tell you when the VAR is there. In VAR calculation or volatility calculation, always a year means 250 days. So normally in questions, they will not ask monthly. I have just given that figure. Monthly means take 30 days. So they will ask monthly, where they will ask 1 month contains 22 days or 23 days. Like this, they will be given. Normally, the daily volatility, if daily volatility, this find the volatility for a 1 year period. So in that case, you have take as question will be given. Assume 1 year period is 250 days, excluding the non-working days. So that will be given. So normally that is the thing question will ask about. Normally the question will come that what will be the volatility for 45 days. Okay, if they monthly, then they will that assume that in a month 22 days or 23 days are there. Normally, VAR questions are these volatility questions are given in that way, so that we should understand that in a year there are only 250 days working days. See, so question will be giving the detail about it. So in that way you can calculate. Now next one is your basis point value. This is another tool for calculating volatility. So what is this? Basis point BPB is a method to measure the interest rate risk. Means if interest rate is changing in the market, then what is the volatility of that particular security? How to calculate? So basically it means that BPV is the change in value of investment. So value of investment means it is talking about currency. So say rupee. Value of investment, it's a change in the value of investment due to change in the market rate by 1 basis point. 1 basis point is 1 BPS. 1 basis point is equal to 1% divided by 100. So it becomes 0.01%. So if the market yield or market rate changes by 0.1%, then what is the change of the value or price of your security? So that is your BPV. Clear? I hope you understood this.
Sir, 0.01 basis point is a constant, sir.
1 basis point equal to 1% divided by, suppose we always take it 1%, 2%. So 1 BPS is 1 divided by 100. So
Okay.
it is 0.0. This is always constant. One.
Okay.
So suppose in that case, suppose 8 BPS is given. 8 BPS is how much?
0.08.
0.08. 12 BPS 0.12. So simply BPS means divided by 100. That will be the percentage.
Okay, sir.
Okay. So BPV is the change in the value of the investment due to change of market yield by 1 basis point or 0.1%. Simple thing. So if you know that, suppose for the market value of investment changes by, say, if the change in the market yield say 2%, and by 2% change, the value changes by say 100 rupees. So for 1 BPS, how much will be the change?
50 rupees.
How?
2% means 100, no sir.
2% means how much? 2% means
0.02.
0.02.
5 rupees, sir. 5 rupees.
0.02
2 rupees.
100. So 0.02 equal to 100. So 100 divided by 0.02 into 0.01. So whatever the amount comes, that will be the thing. So whether it is 50 rupees or whatever the amount is coming. How much it is coming?
$50.
50, sir.
Okay. So that is the, if such questions are given, so you have to calculate that for 0.01% only. Okay. So when you know the BPV, after calculating that, we can calculate our position, whether how much we have gained or how much we have lost. For that BPS, 1 BPS move. Whether, see, when the question says that the market yield increases by 3 BPS, that means whether you are going to lose or going to gain.
Lose the bond price.
Very good. Because market rate going up means your value is coming down. So you are losing. When market rate comes down 4 BPS, that means you have to gain. So for a movement of 0.1% or 1 BPS, how much loss or gain we will have, that can be easily calculated through BPV. So that's why BP has to be calculated. Now we see, so higher the BP of the bond, higher is the risk associated with it. Because since higher BPV means if the market goes up by that amount of yield, then definitely you will have a higher risk, higher loss. So if a bond shows higher BPV, then there is always higher risk. Lower BPV, lower risk with it. Okay, now we can do this example. This one numerical thing. A 5-year 6% semi-annual bond has a market yield of 8%. So here market rate was 8%, has a price of 92. So when the market rate was 8%, price was 92, which rises to 92.10. So market price goes up to 92.10, means definitely market rates come down. So market rate has come down to 7.95. So this is the question. So find the BPV of this one. Can someone calculate this BPV? What is the BPV of this? Anybody calculating?
Sir, 0.02.
Okay. 0.02 is what?
Sir, daily volatility.
Okay.
Sir,
But what is this?
BP. Sir,
What is unit? Unit. What is 0.02? Number, percentage, rupee, dollar. What is this?
sir, rupee, sir, rupee.
Percentage.
Paisa,
Always,
paisa.
always see. I tell you, change in the value of investment. I told you this is to be in currency only. So this will be always in rupee. So here it is rupee. Okay. So I can say it is 2 paisa or rupee 0.02. Clear?
Sir, how it will come, sir? 0.02 paise.
So change in value of investment you want to do for 1 basis point. So here what is the change in the market rate? What is the change? What is the change in the market rate?
0.05.
8 minus 7.95.
So how much that is?
0.05.
0.05. So 0.05 is equal to 5 BPS. Okay. So for 5 BPS, the market price change was how much?
10, sir.
10 what? 10 paisa or 0.01 rupee. So BPV is calculated as 1 BPS. So for 1 BPS, how much? 0.02 or not? 0.10 divided by 5 equal to 0.02.
Yes, sir.
Yes?
Yes.
Everybody understood this? Anybody
Yes.
having doubt?
Yes, sir.
Okay, fine.
Once
So
again, sir, please.
what once again? This is simple arithmetic a class 4, class 5 student can do. Market rate change was 5 BPS, 0.05 from 8 to
Yes, sir.
7.5.
Yes, sir.
So that is 5 BPS. For 5 BPS change, the price has changed by 10 paisa.
Yes, sir.
From 92, 92, 10. So 10% change.
Yes.
So we want VPB. VPB is 1 basis point. So for 1 BPS, how much it will change? 10 divided by 5, na?
Yes, sir.
So that is 0.2. Okay. So
Yes, sir.
BPB, we can say that BPB of this particular bond, which has a price, say face value of 100. So BPB of 100 rupees bond is rupees 0.02. This means for 1 basis point fall or increase in the market rate, the price will increase by 0.02 for this bond. Alternately, you can say, suppose I have a portfolio of say rupees 1 crore of this bond, 1 crore. So for 1 crore, what will be my BPAB? Calculate and tell me. For 1 crore, suppose this is one bond 100 rupees. So I have purchased 1 crore worth of this bond. So what will be my BPV?
20,000.
2000.
So answer is 2000. Okay, because for 100 rupees it is 0.02. So calculate for 1 crore. So 0.02 divided by 100 multiplied by 1 crore. So it will give 2000, not 20,000. Okay. So we can say that the BPV of this bond is 2000 rupees for 1 crore of investment, or 1 crore of portfolio value, or 1 crore of face value, whatever. So now, if we know this, so we can say here, the BPV of bond is this much. So BPV of 1 crore value of the stock is say 2000 rupees. So this we know, 2000 rupees. Now, how here we can calculate easily the gain or loss. Gain or loss for a given change in the market rate. So we know that BPV is 2000. Now we can, if the question says that further the market changes by this much of basis point, then whether there will be a profit or loss. So suppose I say that further there is a movement of 8 BPS point which the market has increased. Now calculate how much I am going to gain or lose.
ये 1 crore के लिए कैलकुलेट करना है सर?
हाँ, yes.
We are gaining 0.20%.
How?
Because no. Profit is 22,000, and before that, previously it was 2,000.
This is not 22,000. This is rupees. Rupees 2,000. Here BPV is 2,000 for this 1 crore. For a 1 crore of portfolio, BPV is 2,000.
25,000 loss.
How? How 25?
For
Simple
1 basis
question.
point.
16,000 loss.
Yes, 1 basis point, 2,000 is the change. So 8 BPS, what will be the change? Simple, na? 16,000 will be what? Loss or gain?
Loss.
Yes, sir. Loss.
Loss. So because market has moved upwards, so there will be a loss of 16,000. Simple thing. So this is just multiply the, see, BPB means 1 basis point change. What is the change in the market value? So 2000 means if the market changes by 1 basis point, this is the change. So if the question is asking, say for 12 BPS, declining the market rate, what will be the first thing? So first thing is, when it is declining, you say it is a gain. When it is increasing means you say loss. Then how much? So earlier 2000 was for 1 BPS, or 12 BPS means 24,000. So this will be the profit. So simply by multiplying how much BPS with the BPB value, we can calculate the profit or loss, whatever the question is asking. Okay, is it clear?
Yes, sir.
So now I have to, so I will say another thing, what is, so BPB of a bond. So bond is issued for a time period. Say bond has been issued for a period of 3 years. Okay, so 1, 2, 3. So 1 year, 2 year, and 3 year. 3 years is the maturity. So BPV of that bond will change when the time advances. So BPV at the beginning of the bond, and BPV at first year, BPV at second year, and BPV at third year will always change. Means the BPV will decline from the initial to the maturity. BPV will decline. BPV declines with the remaining maturity period of the investment. Okay, so if the BPV was 2000, then definitely after 1 year it might come down to 1600. To a second year it might come to 500, and on maturity always BPV should be 0. BPV is 0. BPV will decline with time, and on the day of maturity, it will be 0. BPV becomes 0 because there is no change at all. Because the maturity value will be taken, so BPV will become. So always remember, BPV declines with the remaining maturity of the investment. Okay, so there is no doubt in BPV. Now we'll move to the second tool, which is called value at risk, VAR. And this is the most popular and widely used tool to measure the market risk. Okay, so value at risk. So this gives us an idea about how much we are going to lose in our portfolio. So VAR describes how much we can lose in the portfolio, means we can lose. We can means what is the loss potential which might happen in our investment. So for this, it will have 3 parameters. What are the 3 parameters? VAR has 3 parameters. First is a time horizon. Means whether this is a statistical method where the answer is given or predicted subject to 3 things. One is that answer is about maximum loss. So maximum loss is called VAR. We can call it as a value at risk. That is the maximum loss that might happen. That is the prediction of this VAR. Second thing, it will be predicted for a time period or time horizon. So you can say that this maximum loss of 100 rupees might happen within next 7 days, or next 1 month, or next 6 months, or next 1 year, like this. So there has to be a definite time horizon given for this maximum loss. So it has got the maximum loss amount and a time horizon. And third is a confidence level. So these 3 things are important for a VAR. VAR has a maximum amount of loss, that which describes that how much we can lose the maximum in a portfolio. Second, it has to be given with a time period. So it will say that 100 rupees will be lost within next 7 days, or 100 rupees maximum loss can happen in the next 1 month, like that. So that is time horizon. Next is confidence level. Since this is a statistical method, so that confidence level is expressed in a percentage. So suppose percentage is given as a 90% confidence level. So suppose the var, how var is put forth is that the max var, say var equal to say 5 lakh. My var is say for any investment portfolio, 1 day var is for 5 lakh for a time period of say 1 year with a confidence level of say 90%. This is the statement given by var. So var will be given with three things. One is the amount, one is the time horizon, one is the confidence level. That means within 1 year period, within a period of 1 year, 90% of the days, 90% of days will be there where my investment will not cross the loss for amount of 5 lakh. So 90% is safer range and 10% is the unsafe range. So basically, where is the this 10%? That means this 10% days in a year, my loss may exceed 5 lakh. It will cross 5 lakh. So that's why we should be worried about that and we should take care of that loss. Is it clear?
No, sir.
Why no? What is there? You just see, read this. One var is given. So file, you read this one, then I'll tell you. Why no? What is wrong with it? Var, as I told you, this is the maximum loss that can happen within a period of 1 year or 6 months or 1 month, whatever it may be. It's a time horizon. And with a confidence level means my loss of 5 lakh within this period will not exceed 5 lakh for 90% of the days. So if a 1 year contains 250 days, that means 90% of the days my loss will not go beyond 5 lakh. So 90% means how much? 225 days. 225 days, my loss will be limited to 5 lakh. But 10% of this means 25 days, my loss is going to cross 5 lakh. Now it is clear.
Yes, sir.
Okay. So this is the concept. Whenever this confidence level is given, that level tells that my loss will not cross the VAR limit. This is the VAR. My loss will not cross the VAR. But the unsafe is definitely it will cross. So our focus is in the VAR crossing that thing. So 10% is the crossing thing. Okay. So suppose a bank having 1 day VAR of 10 crore with 99% confidence level or confidence interval means that there is only 1 day in 100 days, or we can say 2.5 days per year based on 250 working days in a year, where the daily loss will be more than 10 crore. Under normal trading condition. So VAR is again subject to one condition, that VAR will give the correct prediction under normal trading condition. If the market is behaving erratically, then VAR may not give you the correct result. So VAR gives the correct result under normal trading condition. Okay, now you do this one. This question you read and do it.
Sir, 23 days.
How?
Sorry, sir. It will be 12 days, sir.
6.25. It's 6.25 days.
Okay, so we can round it up whenever the point comes. If the point is 5 or more, decimal is 5.5 or more, we round it up to higher one. If less, then less one. So in this case, it will be, I can say this is
6 days.
6 days. Simple thing.
How it got calculated, sir?
So in a year, how many days? I told you in a year how many days?
250 days, sir. 250. Okay. 250 days.
For volatility calculation, always remember the year has 250. It will be given in the question like this. Assume that there are 250 working days in a year. If it is not given also, you have to take 250 days in a year. Normally, in the question, it is always given, assuming that a year has 250 working days. Okay, so 250 days in a year. So in a half year, it will be 125 days.
125 days.
So 5 here
5%. 5% it will loss.
5% of 1%, 125, 5% equal to 6.25 is coming. So you can round it up to 6 days on.
Okay. Okay, sir. Thank you, sir.
So next one, you do it.
Eight days.
Okay, very good. So whoever got the answer is 8 days is the correct. Okay, clear?
Okay, 7.5 we can consider it as 8 now.
7.5.
Normally it has to be converted to the round up days. So 7.5 we can tell 8 days. When it's less than 5.5, 7.4 means 7 days. 7.5 or higher is 8 days. Okay. Now read the next question carefully and do it.
$225.
225 days.
225.
225 days.
Very good. Excellent. So always read the question carefully, because what question is asking? Here it is asking may not exceed. So we have to take 90%. May exceed means 10%. So that is the difference. So in a hurry, you should not read the question. So always read the question what he is asking. Sometimes we make a mistake. Some people here, they will not read because I have highlighted here. So that's why you can see it. If I have not highlighted, some might have taken that 10% thing as 25. So that is not the thing. Okay. So now,
Sir, why we have taken 90%, 110%?
Here may not exceed is given, na? Confidence level means how many times I've told you. Confidence level percentage shows that our loss will not exceed that VAR. And the rest percentage is unsafe. That is, that will exceed our VAR.
Okay.
That's what I'm going. Last 3 examples, I'm explaining the thing. Okay, now, how this VAR is useful? Because VAR is a tool which is used to calculate the loss of any investment which might happen, so that we can take protection against that loss. So it is a tool for protection of banks' business, so that our customers, shareholders, employees will be safer. So it will be, VAR is used to calculate the measure of potential loss, or calculate the potential loss, maximum loss that might happen in a portfolio. Okay, so basically it is a very important or component or important tool for calculation of any investment portfolio or market risk portfolio. So only limitation of VAR, as I told you, VAR works under normal trading condition. That is the only drawback or limitation. Normal market condition. So if the market is behaving erratically, or if that erratic market behavior is called worst case scenario. So in worst case scenario, VAR is not going to predict you the correct result. Sometimes questions are asked, so you can remember. VAR is going to give you correct prediction under normal market condition. Or it can be said that VAR is not a worst case scenario analysis tool. Okay? So VAR is to be done like this. Now we'll move to the next one. After risk measurement, third one is risk pricing. The risk pricing means what? Pricing means basically how we are fixing our rate of interest to be charged to our loan portfolio. What is the rate of interest we'll charge to the borrowers or who borrows money from us, whether it is through loan or borrowing from the, how we are going to fix this interest. Can somebody know how this rate of interest of any loan is fixed by your bank? How this is created? What are the factors taken into consideration for rate of interest calculation?
MCLR.
MCLR plus the
MCLR.
bank.
MCLR is the rate of interest. How you arrive at MCLR?
Credibility of the customer.
Credibility of the customer. How? So your bank's MCLR is announced. Say your bank MCLR is 9%. So how you are arriving at MCLR to be 9%? What is the calculation? That is what my question is.
Carrying cost of funds plus operation cost plus risk, whatever we are taking,
Yes,
and ROA,
yes.
return on asset, how much we need, all these things we will be calculating.
Okay, very good, excellent. So there are 6 or 7 factors which are taken into account for arriving at the rate of interest. So out of that 6-7 factor, one factor is your risk. Risk means basically in the loan, what is the risk? Normally risk means credit risk, or we can call that default risk. So that is NPA, or we can call that is the loss. With the loss which might happen. So according to that, we have to factorize that loss and add to the future interest to be charged to the loan. Okay, so this is what the risk pricing is for. So what will be our loss in our loan portfolio or credit risk? We have to account for that for the future loans where that factor has to be added, so that our interest is minimum that much. Okay, so this is about the risk pricing. So risk has to be accounted for in all transactions. So risk management says that your calculation of risk pricing has to be done at all transaction level. Every transaction level means one loan you are giving, for that you have to decide how much interest rate you are going to charge. Okay. Second thing is about that there are 2 important things for which risk needs to be accounted for. Why? First is maintaining the necessary capital. Capital has to maintain. Risks management says that you calculate the capital and maintain the capital. So maintaining the capital required amount of capital. And second is to cover for all the probability of loss due to default. Okay, so these are the 2. So now in maintenance of capital, what is the cost involved? Probability loss due to default cost is that how much you are losing by NPA or default by the borrower. So that is the cost of loss due to default. Now what is the cost involved in maintaining the necessary capital? Because for capital is very essential for any business. Capital is essential, or it's the basic or fundamental thing for any business. And as for banking business, It is a regulatory requirement. RBI says that you have to maintain that minimum capital. So that capital has to maintain. So capital, when it's maintained, it comes with a cost. What is the cost? Number one is capital you have asked from the public. So most of the banks, we have gone for public issue and public has invested in your capital. So publics are your government and public. For nationalized bank, government as well as public are the shareholders, or they are the owners. So you have to pay your shareholders or owners dividend. Dividend has to be paid. So when you dividend paying, that is one cost. You have to earn that profit to pay them dividend. Second thing is that after the capital is maintained, then every year you have to strengthen the capital, add something to the capital. Where from that amount comes? That amount comes from the profit. You earn the profit, and profit is the source of strengthening the capital or enhancing the capital. So internal generation profit has to be there, which will show that your business is growing. So to earn profit again, you have to charge more or charge a adequate amount of interest in your loan portfolio or investment portfolio you get. So these are the costs. So to arrive at that, or to load this factor to the rate of interest to be charged to the loan account, one of the factor is your risk factor. So therefore it is said that banking transaction risk pricing means factoring risk into pricing through capital charge and loss probability. So capital charge is nothing but maintaining the necessary capital is called capital charge, and loss probability is to cover the probability of loss due to default. So that is the basic meaning of pricing the risk and adding that factor to rate of interest. Okay, now this is apart from the actual cost incurred in the transactions, such as cost of fund, cost of providing services. So that is what, when I asked what are the factors which decides the rate of interest, because these are the factors. So cost of deployable fund, or we can call this cost of fund, cost of the fund. Cost of the fund means whatever deposit you are having from public, what is the interest you are paying to them? That is your cost. So you are borrowing money from public as a deposit. You are borrowing money from the public. So what is the interest or average interest paid? If you stop the background, then I can proceed with the class. Background sounds.
Deployable funds, operating expenses.
As long as sounds are coming, I will not start the class. Please mute your mic and take control of your sound. Very disturbing. Okay. So cost of fund means how much deposit you have taken from public and what is the rate of interest you are paying, total interest you are paying. So that can be factorized as average rate of interest paid on the deposit. Say average rate of interest paid is, say, we can say that 4.5%. So total deposit, savings, fixed deposit, everything, take it together, divided by number of deposits. So you say that 4.5% is the deposit we have accepted from the public and paying the average rate of 4.5%. Now, next one is operating expenses. Operating expenses means for all the expenses incurred by the bank for operation, like staff salary, rent, taxes, electricity, water, other repairing, maintenance, everything. So this comes this has to be what is the operating expense you have spent for that year divided by how much it has done. So we can say, we can factorize that into percentage. So we can say it comes to out say 1.5%. Then this loss probability. Loss probability is nothing but loss due to default by loan, default of loan by the borrower. So this is the risk factor. This is the risk factor. So loss probability can be also calculated. How it is calculated? Loss probability is calculated by going backwards. Say for a 5-year period, last 5-year period, you can go back, or 10-year period, you can go back, and you can calculate here. Suppose one portfolio you take. Suppose a portfolio like say housing loan you take. In housing loan, for the last 5 years, you see that how many housing loans have been given, say X numbers of housing loans given for an amount, say Y. X number of loan has been given, Y is the total amount disbursed. Out of which Z number of loan has done NPA with amount of say A. So we can say that out of 100, suppose simply 100 loans were given where 1,000 was the disbursement, out of which say 5 loans have gone bad, where the loan amount gone bad is say 30. So now we can factorize this. That means out of 100, only 5 loan has gone bad, and the amount which has gone bad is say in 1,000 is 30. So we can say 3% loan has gone bad. So this 3% loan gone bad means how much loss we have incurred, that we will calculate, and we will factorize into percentage again. So that percentage comes say 1.5 again, suppose. That means for the last 5-year period, our loss was 1.5% per annum. So that 1.5% I have to recover in next 5 years, in future 5 years. So I have to load this factor into rate of interest of loans. So I have loaded this one. Okay. Now capital charge, as I told you, this is the calculation of capital or capital minimum capital requirement for which the cost we have to incur. That is the dividend. That is the payment of dividend as well as maintenance cost of or earning profit. So I can say this cost is say 0.5. Then another thing which is to be added, sixth one I first. Now RBI is told a repo has to be also considered while deciding the rate of interest. That means repo factor has to be also added or deducted. So whenever repo is increasing, you can add that factor to your rate of interest. When the repo is decreasing, you have to give the benefit to the borrowers. So repo, suppose repo is a 0.1% or 0.01%, whatever it may be. So this is the factor of repo. So when you recover all these things, add all these things together, except the fifth one, profit margin. So your rate comes to how much? $7.21. So 7.21% if you charge to the borrower, you will be at break even. Means there will be no profit or no loss. So this is the recovery of all the costs which are expended by you. Now bank want to earn a profit also. So you have to earn a profit margin. Say we can say that I want to earn profit margin 1.5 or 2%. So in that case, you fix.
How?
8.21, sir. 8.21.
So you can decide that this is your MCLR. 7.21, you add this 4.5, 1.5, 1.5, 0.5, and 0.1. Adding is 7.21. I have added all.
Sir, 8.21.
8.01?
Yes.
8.01, sir.
Okay,
Yes, sir.
8.01. Okay. Okay, 8.01. Then you have to add your profit, say 2% you are adding, so it will be 10.01. Okay. So this is the way risk pricing has to be taken care of.
Sir,
Hmm.
I have a question.
Hmm.
For some loans, the rate of interest is RLLR plus some CRP above RLLR.
Okay.
Okay, so in that case, this RLLR is comprising of all these factors.
Some of the factors, see, RARs, as you are talking about the retail portfolio, right?
Yes, yes, sir.
Only retail. So retail loans,
both in retail and MSME. In
MSME and
MSME,
retail. See, nowadays, all this thing concept has come where you have, if say MCLR is there, MCLR is there, then for other thing, retail thing is there, MSME is there, so many things are there. Okay, so all these factors, it might change where you are, your MCLR might differ from your retail rate, because there might be a difference, because the difference is about the loss probability. Loss probability might be less in retail loans than the normal traditional loans. So that's why retail loan, your RRLR might be less than the, if suppose your MCLR is say 8.5%, this retail what cap is given, so that might be 8%. So with that, again, you are adding some other things according to different factors, according to the risk of the borrower, according to the tenure of the loan. You have to add more things. So again, you are adding this loss probability. So rating of the
so
borrower
the
is again
CRP that we add above RLLR, that is the loss probability.
That is again, so one loss probability you have taken already in here, extra loss probability you are adding here according to the rating of the borrower, tenure of the loan. So many factors are there. So those are decided by your head office, how much you are going to add to this customer.
Okay.
Well, this will be the base. This is the base retail rate. This will be base MCL rate. After that, you add risk factor again. So those are because of risk, we are adding this factor, and due to different kind of risk, different, so 1 or 2 or 1.5, 2, you have to add.
Okay.
Okay.
Yes.
So is it clear about risk pricing? Now, next chapter, next step was risk monitoring and control, that I am not going to discuss, because monitoring and control is a simple process where continuously the thing we are doing in a bank has to be monitored by your head office, and there has to be control on this. That as per the policy, everything for risk management is controlled and it is monitored by the department, so that nobody falls behind the objective of the bank, whatever the risk policies that they're following. So risk monitoring control is not a bigger thing. Okay. Now, last step of risk management is risk mitigation. So risk mitigation means to reduce the severity or the painfulness of something through some other means. Mitigations literally means how to reduce the pain of something through some other means. Or I can say mitigation is a strategy to reduce the loss. Basically, we are talking about losses here. So to reduce the loss, how you are going to reduce the loss which is arising out of any adverse nature of uncertainties in future. Is there any procedure to reduce the loss in our different types of business? Okay, so that is a mitigation. So for credit risk, so we have, I can say that banks business can be divided into 3 type of major risks. So one, we are giving loan. One, we are making investment. And third is other than loan and investment, whatever the business we are doing, deposit and so many, borrowing, everything. So this can be other. So for loan, what is the risk? Risk of main risk of loan is that the borrower may default. borrower will not pay back your money. So basically you can say when this is turning NPA. So that is the risk in loan. In case of investment, what is the risk? Risk is that your market rate or market value of the investment will come down, so that you will have a loss. Okay, so that, or it might be a default also, default by the counterparty who has issued that security. He might not pay back you, or the value will come down. So there are so many risks in the investment also. And other means any other thing might happen. So other than these things, any other thing like system failure, process failure, a fraud happens, a earthquake happens, fire happens. So those are basically termed as operational risk. So we can say loan has credit risk, investment has market risk, and other thing have operational risk. Operational risk present everywhere. So three major type of risks are there in our portfolio or banking business. So how to reduce the loss in credit risk? Can somebody tell me how the banks are, what banks are following to reduce the or to compensate the loss in the loan portfolio?
By taking security.
Very good. So basically, we obtain security while we give a loan. So collateral so for credit risk mitigation purpose is collateral as in the form of cash or securities or landed properties we are taking. Sometimes we also take third-party guarantees, or sometimes some credit derivative instruments are also taken to cover the risk of credit. Okay, so we know the mitigation process of any credit risk. So this is the mitigation. Now for market risk, what will be the mitigation process? In market risk, again, it will be two types. One market risk will be pure domestic market risk, another will be foreign exchange risk. So for to cover the losses which is happening in the market, so what kind of things we can cover, we can take? What banks are doing?
Insurance.
Insurance. For investment, what insurance is you are doing?
Hedging, sir.
Yes, hedging. Hedging means how you are doing hedging? Hedging is done by?
Forward option futures.
Yes. Hedging is a process which is done through various kinds of financial instruments or technique. So basically, you can say that interest rate swaps, forward rate agreements, forward contract, options, futures, they are going to cover your market risk. So process of hedging is done to cover the losses in the market risk. Clear? So we have done it for credit and market risk. Now for operational risk, what is the process banks do? To cover the losses which is occurring due to operational risk, what is the mitigation process?
So like insurance?
Yes, only insurance is the process, nothing else. Is there anything is there in your mind?
Yes, sir. Nothing,
What?
sir.
Nothing. Other processes cannot protect the loss. Other process may help you reducing or may alert you, but they are not reducing the loss like a collateral or like a interest rate swap. So only mitigation process for operational risk is available in insurance. So you have to take insurance of all your properties, everything, or your cash, movement of cash is lost or cash is looted by somebody. In that case, insurance will help you. So in case of fire, insurance will help you, or any furniture fixture, or even your system crash or anything, insurance might give you protection against the hardware crash or something what will happen. So insurance is the only thing which is available to protect you from operational risk. So these are the risk mitigation process. Okay, is it clear? Apart from this, another important method is also carried out by the bank to cover credit as well as market risk. So that is most important, which I have not written here. Sometimes numerical questions also, they come into picture. So that part is called, so you might be knowing about that, how to reduce the risk through a process called diversification. What is diversification? What do you understand by the meaning of this word diversification?
Diverting a portion of funds to non-related activities other than the bankings or something, maybe for investing in other shares or something.
Okay, so diversification is basically diverting into more, whatever the resources available, what are the avenues available. So you should not do one thing only. You can divert the business or your investment, whatever is that, to more than one. So this process of diversification is done for what? Basically, it is done to reduce the risk. So by process of diversification, risk is considerably reduced. So how this is done, I'll just explain, and you should be careful to calculate those things so that if the question comes in the examination, you can easily ask. So that is called mitigation through diversification, or mitigation through managing the portfolio risk through diversification. Okay, so let us understand a very simple example. Suppose Mr. X, say Mr. X was there. Mr. X has only one business. So business is called business A. He is doing one business, suppose. And these are the past 5 years net cash flow. Net cash flow, or we can say this is the profit he has earned for these 5 years. So these are the net. So now you see that the profit or net cash flows are not constant. All the years it is not constant, it is variable. So when the net cash flow is not constant, that type of business is called, what type of business is called? Or we can say if the net cash flow is constant or not varying, that business is called
Zero risk.
Zero risk.
Yes.
So zero risk or risk-free business. So here, since net cash flow is not constant, it is variable. So we can say that this business is risky. It has got some risk, right? Because the net cash flow is not constant. So it is not risk-free business. And how to measure what is the amount of risk we are having in this business? This can be measured by finding out the standard deviation, as you have done it in that volatility thing, and finally finding out what is the standard deviation to mean percentage. So that will give us the risk involved in this business. So I have calculated the total here. Then I divided by 5, so it mean is 7.20. Then I have calculated the individual deviation, means year 1 cash flow minus mean, that I have taken. Then I have squared that one. After that, I have taken the average by adding up that divided by n minus 1. Then whatever the result comes, I have squared it, a square root of that. That square root is standard deviation, as I have explained it into the volatility method. So I am not here explaining again. So your question will come like this, up to this standard deviation they will give. Now risk factor in this business will be calculated by standard deviation divided by mean into 100. So I can say that this is 49% risky. 0.49 means 49%. Is this, if you have understood this, then we will see how diversification of portfolio or business will reduce the risk. Is it clear?
So
Any question?
3.56. How it will be calculated?
How you have calculated in the volatility? After mean, I told you now there are 3 steps available. After mean, you have to find the deviation. each deviation you calculate. Deviation is the difference between each cash flow to the mean. So 10 minus 7.20, 3 minus 7.20, whatever this is coming. Then square of deviation, so d square. Then add this. Then this amount, whatever the x amount is there, x divided by n minus 1. So there are 5 means x divided by 4. And whatever the amount comes, square root of that amount is the standard deviation. I have explained in volatility. That's why I'm repeating here that I will not again explain this one. I have skipped those columns and I have arrived at the standard deviation. Okay. So that means if standard deviation is here, that means this is the volatility. Volatility of my net cash flow from the mean. So from 7.20, it has deviated 3.56 towards the lowest and towards the highest. And a risk factor can be calculated by simply standard deviation 3.56 divided by 7.20 is the mean into 100. So this will give the percentage. Say this is 49%. So this business is 49%. Am I clear now?
Yes, sir.
Okay. So now how Mr. X can reduce this risk from 49% to further by diversification, we'll see. Okay. So we'll see that suppose now he had this A business where the business was 49%. Now he has introduced 4 more businesses. He has diversified his business to B, C, D, E. And we have also taken the 5 years net cash flow of each business. And we have calculated the standard deviation of each one. And also calculated the standard deviation or mean of the each one. And finally, we have also calculated the total portfolio net cash flows and total portfolio risk. Now you see, when he was having one business, his risk was 49%. Only one business. Now he has introduced into 5 business where he has different risk. So highest risk was 61% in case of business B. Lowest was 36% in business E. But when we work it out, consolidated all these 5 business together, we see that the risk factor has come down to 25%, which is definitely lower than the business A, but also lower than the lowest which you are having business E. So how drastically the risk has come down by diversification. Okay, so this kind of business, this is the riskiness when we compare it to the other type of business available in the market. So ratio of SD to mean is different for different business portfolio. So these are the business portfolio again. So it's likely we can, while giving loan, bank can diversify the loan. Different types of loan you give. Housing loan, your personal loan, your vehicle loan, your traditional loan. So many types, 100 types of loans are there. So that is the way we diversify. Some loan we have a more risk factor, some loan we have a least risk factor. So when we took together, our risk will be reduced. That is a mitigation process. Similarly, investment portfolio.
Sir,
You should not
25%. Hello, sir. Sir, 25% it came as how it came 31.20 divided by 7.85.
7.85 divided by 31.20 into 100. How much it is coming?
Okay. Acha, acha, acha.
Here it is written SD divided by mean percentage. SD is this column, mean is this column.
Okay, sir.
Okay? Okay. So this is the process of diversification. Is it clear? How? Through diversification we can reduce. So question will be asked. They can give you up to this standard deviation they will give you. Now the question will be asked. This column will not be given the question. So through diversification, you can say, so question is, what is the maximum risk in the business carried out by, in which kind of business, in which, which category of business Mr. X has the maximum risk. So you can find out that this is the 61%. So you'll say that business P has the maximum risk. Sometimes you ask which business of Mr. X was having least risk. So least risk was business E. This was the least because 36%. So third thing, some question might be asked that after diversification, what is the total portfolio risk, how much it has reduced? So you can say that if the first business was 49%, now it is 28%. So you can say that the business after diversification risk has come down to 25%. This type of questions will be asked. So you have to know that how this percentage, risky percentage arrived. It is nothing but standard deviation to the mean multiplied by 100. That is the standard deviation mean percentage. Okay?
Sir, if mean is less, the risk is high, sir.
You see what is the thing coming. Mean, I don't know. You calculate whether mean is less. So mean is less means risk will be high, or mean is more less high. You see what will happen. So ratio is the SD divided by mean. So if your mean is higher means risk will be less or risk will be more.
Less.
5 divided by 20, 5 divided by 40. Mean is more. So which is the less? When mean is becoming more, when mean is more, your risk is becoming less. Okay. So that is not the question, will not ask why you are asking such a question. Only thing you should remember, what is the percentage of risk? And risk is calculated through SD by mean ratio. That's all. Okay, now last slide we'll discuss here. I'll just give a brief hint about why this risk-based regulation has come throughout the world, and why regulator in the financial world, they are always very strict on this Basel recommendation or maintaining the capital. Why this banking committee of supervision has come into picture, BCBS has come. What is the role of Bank of International Settlement, why they formed there? So this leads to one of the incident which happened on 26th of June 1974. A thing which has happened which actually triggered the basis of this Basel thing. So what happened? There was a bank called Herstatt Bank. Very briefly I will give the incident, because this story is narrated in the Macmillan book. You can read that. So Herstatt Bank was a bank in Germany. So they borrowed money from USA, 3 or 4 banks called money market. They borrowed US dollar. Millions of US dollar was borrowed by them. So next day it was supposed to be paid back. So overnight, this was an overnight call money market, overnight money without any security. Say 500 or 600 million they bought from 3 or 4 USA banks. So next day they are supposed to square it up. But next day, what happened? German's central bank or regulator, Bundesbank declared that Herstatt Bank has failed and it has been closed since. So you see, these 3 or 4 banks which has lent money overnight, what would be their state of? They were totally shocked about this. Since there is a time gap between these two zones of USA and German. So German is towards the east and US is toward west. So when German in the morning they published this one, USA was not open. So there was a time gap also. But thing has happened that entire bank was closed. So German central bank or regulator says that this bank has collapsed. So this led to the loss of that much of money during 74. So this much of million of US dollar has lost by 3 or 4 banks. So it sent a message to the entire financial world totally. They were totally shocked. and they could not protect. So these banks, they alleged that Bundesbank, the regulator of German bank, knew the health of this bank, that it is going to fall. But they did not disclose it earlier because not a single bank fails overnight. Gradually, the profit will be coming down. At that time, the central bank's job is to know or regulate the bank and tell to public that this bank is not doing well. So don't deal with the bank. So if this US bank, they knew that the health of this Erste Bank was not good, they would not have lent that money to Erste Bank. So they alleged that even though the regulator of German bank, they knew the thing about the health of this bank, they did not disclose it for the benefit of others. So this was a very big issue. Finally, a group of 10 countries, they were the most developed countries, group of 10, they sat together and with the help of Bank of International Settlement, they finally sat together and they arrived at a decision that one fundamental benchmark to be assigned to a bank, which might be based on the capital, how much capital they are maintaining, so that from that particular benchmark, anybody who sees that benchmark can decide whether the bank is healthy or safe or weak or unsafe, so that we are not going to deal with the bank. People will also know about that. People will also not. So basically, it is about the strength. This will tell the strength or this is the weakness. So that benchmark has to be there. So they told that that benchmark should be translated in the form of capital maintenance. Because prior to that, every country was following an arbitrary rule of maintenance of the capital. From east to west to central, everywhere there is no uniform rule applicable. So this group sat together, they did a historical study and research was carried out for a years together and found out that there was a common region where the bank's failure was seen most. And the common reason was wherever the capital was weak, those banks failed easily. So they introduced this concept of minimum capital requirement. So basically, these G10 countries formed this Basel Committee on Banking Supervision, that is BCBS, under the patronage of Bank of International Settlement. And the Basel Committee recommendation was formed there. And the first time when it was done, so they suggested, this BCBS suggested that the minimum capital requirement should be 8% of the risk weight asset of credit. Basically, they thought at that time that credit portfolio is the only risk portfolio. They did not think about the market risk or operational risk. They came later. But when it was introduced in the year 1988, so it was told that every bank has to maintain 8% of capital on the basis of credit risk weights, total credit risk weight. Suppose your total credit risk weight is 100 rupees, then you have to maintain a capital of 8 rupees. That was the prescription of Basel. But in India, this 8% is still remains for Basel, but for India, RBI has increased that 8% to 9%. Because they told that you can raise that, but you cannot lower this from 8%. You can suggest more to keep the Basel for your safety as per the condition prevailing in the country, but you cannot tell that it will be lower. Okay, so that was the prescription. So basically, this credit risk 8% was introduced in 1988 under Basel I. Then, after some time, they thought that investment portfolio has also had risk. So in the year 1996, market risk was introduced to cover the investment portfolio. Then Basel II was introduced, and within this period 2008-9, operational risk was also included in Basel II. And Basel II came because certain things were there in Basel I which are not giving good result or for which the banks were not satisfied. So revision or modification of rules and regulation happened, and Basel II came in the year 2008-9. Then in the year 2013, Basel III was launched all over the world with more stringent guidelines and some changes in different types. And now it was supposed to be completed in the year 2019, but because of that it has been extended and pandemic happened. So we are still in the process of Basel III only. After everywhere the Basel III is completed, a compliance of Basel III is done, then only Basel IV will come into place. Okay, so this is the history of this Basel thing. We will discuss the rest in our next class. Okay, any question till now? You can ask me.
Yes, sir.
You can ask me.
Sir, in that BPV calculation slide.
What is BPV?
Yes, sir.
What is the calculation?
Sir, one question was, time is 5.6%, semi-annual market yield 8%, price was changing from 92 to 92.1%. Sir, in that, what is the use of the 6% semi-annual at market yield? Nothing.
Nothing. Just to give you, or just to distract you from this, that was given. That has no relevance.
Sir, could you please explain first question of VAR, sir? I got disconnected, and when I connected, it was already the third question.
First question is this one?
Yeah, first question, any one question, the first question, any questions?
Here, can you see the first question here?
Yes, sir, I can see.
So, one day VAR of portfolio is 5 lakh. That means maximum loss maybe 5 lakh or more with 95% confidence level. That means in a year, 95% days we will not lose more than 5 lakh.
Okay, sir.
Confidence level you should understand. Confidence, see, this 5 lakh is the VAR amount. I've told you, VAR has got a maximum loss that is called VAR amount. This is the VAR amount. Then there is a confidence level which is given in a percentage, and there is a time horizon within what time period it happened. So here, one day VAR of a portfolio of 5 lakh. So VAR amount is given as 5 lakh with 95% confidence level. So one day VAR is there. So find out in a period of 6 months, how many times the loss on the portfolio may exceed 5 lakh. So here 95% denotes that the maximum loss will not exceed 5 lakh.
Okay, sir.
So what is the percentage when the loss might exceed 5 lakh?
5%.
5%. That is the meaning of this confidence level. So only 5% of the time the loss will exceed 5 lakh. That is what we have to calculate, because the question is asking that. So we know that for VAR or volatility calculation, how many days are in a year?
250.
250. So out of these 250 days, only 5% of days our loss will exceed or go beyond 5 lakh. So 5% of 250 equal to how much?
25 days.
5% of 25, 250.
12.5. 12.5. Sorry, sir.
12.5 is the days for a year. So here the question is asking half year or 6 months. So in 6 months, how many days it will be? 6.25? 6.25. So 6.25, we can round it out. So it will be 6 days. So answer will be 6 days.
Okay, sir.
Okay, or directly you can do, or directly you can take here, half year has got 125 days. So 125, 5% is again 6.25. So answer will be 6. Okay.
Can you please,
Okay, sir. Okay.
Sir,
can you please repeat the concept of BPV once again, sir?
BPV means what is the change in the price of any investment if there is a change of 0.1% in the market rate. It is unit. It is given 1 BPS.
One BPS is standard unit.
Is 1 BPS equal to 1 by 100 only. That is the standard. 1% means what? 1% means what?
1 by 100.
1%. So basically rate of interest moves in the percentage, right?
Yes, sir.
So rate of interest are moving in percentage. Suppose rate of interest increases by say 3%. So what is 3%? Can you convert 3% into basis point BPS? How many BPS it will be? Simply
0.03.
3 divided by 100. BPS means any percentage which is divided by 100. So that is the BPS. Okay, if it is 30%, 30% BPS, how much it will be? 30 divided by 100. So it will be 0.3. So BPS means that. So 0.1%, 0.01% change in the market rate. What is the change in your price of the bond or value of your investment portfolio? So that is the BPS. So can you not calculate here in that question? I have calculated. Na? For a change of 0.05%, there is a change of 0.10 paisa. So can you calculate what is your BPA, BPB? BPB means 0.01%. So if for 0.05 it changes by 10 paisa, for 1%, what will be the change? That is the BPB.
Yes, 0.10 divided by 5.
Into 0.01, because here 0.01 is the base. Na? You have to multiply with 0.01. If
yes.
Okay.
Yes, sir. Yes, sir.
Okay, then see you tomorrow again.
Bye, sir.
Thank you, sir.
Bye, sir. Thank you, sir.
Thank you,
Thank you,
sir.
sir. Thank you very much.
Welcome.